Hello, my name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. And periodically, I like to do a market update via video like I'm doing now, specifically for my clients, and really just keep everyone up to date with regards to what's going on. So if you're a client of mine, you know how seriously I take that. I thank you for your trust. I thank you for your business. If you're not a client of mine and you want to have a conversation about anything that we've talked about here in this video, just feel free to contact us through our website, which is providencefinancialinc.com. Now, either way, whether you're a client or not, if you've gotten this video immediately after I have uploaded it to YouTube, that is because you have followed us on YouTube. And by doing so, then the moment that the upload to YouTube is complete, YouTube sends you out a notice that says, hey, Providence Financial sent you out a video. If you are not a follower of YouTube, then you're going to get this video notification via a newsletter as long as you're on our newsletter list. Now, in times like this, where things are very urgent, we're going to send out the newsletter right away. But in times when things are a little less urgent, then it may take a day or two to get the newsletter. So I would encourage you to just go and follow me on YouTube because things are happening very, very fast. And in today's world, if you don't get it for an extra couple of hours or an extra day, if you don't get this video, then that could be something that affects you just because of how fast things are happening. And I want to start off this video by saying happy anniversary. Happy anniversary. You might be thinking, what's that mean, happy anniversary? Well, I've actually missed it by 2 days. I apologize. This is March 21st, 2020, and the anniversary was actually on March 19th, 2 days ago. And it was actually a month-liversary. So it was really a happy 1 month anniversary on March 19th. 1 month anniversary of what? It was 1 month since the Standard & Poor's 500 hit its all-time high. I know it doesn't feel like a month, it feels more like a year, but the reality is that in the last 30 days, the stock market has come down from its all-time high about 32% to where we are today. Things have happened extremely quick. And these are really unprecedented times. That is the fastest drop the market ever has taken ever. It's not the deepest drop that it's taken, but it's certainly the fastest. And it's completely different than the financial crisis in 2008. The financial crisis was really a lockup of liquidity, banks not being able to loan money, foreclosures on homes, people invested in what they thought was AAA paper with regard to mortgages that turned out to be very bad subprime mortgages. So this is a completely different scenario. It's not about lack of liquidity. The banks are strong at this point. The balance sheets are good. It's more about the fact that in just 30 days, the revenue has been cut off from a high percentage of American companies. So it's a completely different scenario. And I think it's just important to understand that. So it's only been 1 month since that's happened. Now, there's a couple of things that I want to cover in this video. The first thing that I want to cover is the fact that at Providence Financial, we have now activated our emergency contingency plan. What does that mean? It means that we have shut down the office in Woodland Hills and we are all working from our home. So what's that mean to you? It really means absolutely nothing. With the world of technology today, we have the ability through our phones and our computers to connect to each other just like we were in the office. If we are in the office and we want to intercom someone, we can press a button and intercom them. If they're available, then we can talk to them. And we can do that on our cell phones today through the technology we're using. If we want to look up your accounts that are saved on our secure servers in the office, well, we have the ability to look those up by remoting into our office and seeing exactly what we would be seeing as if we were sitting at our own computers in the office. So our phone lines, everything is forwarded at this point so that when you call our number, you're going to get a live person that answers the phone. And so it's important to know that from your standpoint, there is nothing that's going to change as far as your experience is concerned. Emails still be responded to within 24 hours. That's our policy, and certainly we try to do it a lot quicker than that. Our phone lines are going to be answered just like they have. If all of you or some of you decide to call in all at the same time, and I don't know what it is about that, but that happens frequently. It seems like we'll go for a period of time where no one calls, and then 5 people or 6 people will call in at the same time. And if you get a voicemail, then we'll certainly return your call very quickly. But that's really the only reason that you'll get a voicemail during business hours. And I'm making myself available too. I mean, we're not going anywhere, right? My wife is here and just nervous about the whole touching everything and social, what do they call that? Spreading out, and make sure you don't get too close, social space distancing, I guess. And we've got 2 young kids, so she's worried about them. We have a 7-year-old Aiden and a 3-year-old Audrey, so we're not going anywhere. So, while I'm here, I'm certainly not above calling you, and I'll certainly do that. So don't be surprised if you have a question and you email me and you get a call from me either after hours, or if you get a call from me, even on the weekend. We're doing the best we can to calm the jitters that everyone is kind of feeling right now. So just know that as far as you're concerned, it's no different for you. And obviously that's why I'm recording this video from my home office, because we're now at home. And the governor just issued, well, let me rephrase that. We know that the governor issued everyone to stay home, but I just read a report no more than an hour ago that I think it was the governor that was saying that all of this is going to be in place until I think the date was April 7th. You can go look that up, but it was certainly in April at some point. But anyways, whenever it was, I kind of calculated it to be about 30 days. So I guess that would be like April 10th. But somewhere in that range, for the next 30 days, we're probably going to be operating in this situation. Again, it won't matter for you. So thank you for being patient with us as we continue to move forward and be able to answer your questions. Speaking of questions, the rest of this video, I want to focus on really 2 main questions that we've gotten over really the last couple of weeks. And I know that if we get them from multiple people, then a lot of people that even aren't asking the question probably have the question. And I think the questions can really boil down into 2 broad categories. The first category is just a reminder of why income investing is different and how it is that the income can stay the same even the portfolio value fluctuates. And so I want to answer that question. And the other question really has to do with why have your investments gone down to the degree that they have? We're a very conservative firm, and yet your investments have fluctuated down quite a bit, and people are saying, are asking us why. So I want to answer that question, and I have to tell you, I'm very proud of you guys. We have a handful of clients that really, I feel like they need hand-holding and babysitting and just, I'd say nervous more than normal. But I'm going to say that 95% of our clients just understand that they're invested for income. They understand the income story. They understand how it works and really have just gone with the flow. And in a time like this, you don't have a choice. You have to go with the flow. Again, we're in unprecedented time. So, but I do want to talk about those 2 things. Let's talk about why investing for income is different. Some of this is going to be repeat, but I'm actually going to go deeper than I have before. So a lot of this is going to be new information. And then we're going to talk about specifically why your investments have gone down 20 or in some cases even 30%. So we're going to talk about that as well. So let's talk about first, what is different between investing for income versus investing for growth? And the first thing is that when you're invested for income, your income stays the same regardless of the share price. So if you are invested for growth, on the other hand, then the performance of your portfolio depends on the share price, right? So you buy low, you sell high, you can make a lot of money, you can lose a lot of money, it can all happen very quickly. There's going to be a ton of volatility. And as we talked about in the video that I did last week, if you bought into the market in 2000 at the stock market, then you lost money and it took you till 2006 for your stocks to get back to even. And then again in 2007, if you bought into the stock market in 2007, then you lost money and it took you until 2014, 7 years to get even. So the bottom line is during that 6 or 7 year period, if you're invested for growth, you don't make any money because you just drop and break even. It's all based on the share price. But if you're invested for income, then your income is going to remain the same and you're going to be consistently getting that income, even if your portfolio drops and recovers. So if you have, say, $500,000 and you are getting 5%, you're getting $25,000 a year of interest and dividends, then if the $500,000 drops to $250,000, you're still getting $25,000 a year. That doesn't change. Okay? And so if it takes even 5 or 6 years for your portfolio to get back up to $500,000, well, that's not a big deal because you've been getting the $25,000 a year in and year out, year in and year out. So you didn't just break even as if you were invested in the stock market. So, and that's really what makes investing for income different. And, I'm going to repeat myself because some of you have come back to me and just wanted me to remind you of the rental analogy. Some of you have specifically asked me to help you to understand that again. But the rental analogy, if you took your same $500,000 and you bought a home with it and you rented it out for $25,000 a year, well, then if that home drops 25 or even 50% in value like they did back in '08, well, as long as your rent keeps coming in on time, do you really care about the value of the home dropping? It doesn't matter. Even if it takes 10 years for that home to get back to $500,000, as long as you've been collecting this rent all this time, then all that fluctuation and that drop in recovery did not hurt you because you've been receiving that income. And I know I sound like a broken record, but I know that I've had conversations with a lot of you that, that just want clarity on that. But we understand that. I think a high percentage of you are saying, yeah, this is the same thing that we've talked about before, and you're right. But the question we've been getting recently is why? How is it that the income doesn't change even though the value of my portfolio changes? How is that? Well, and the reason is because all of the investments that you have in your portfolio have a par value. Now, a par value is a value that is tied to income producing investments. It's really what companies or issuers of investments say that they are worth. And yet there's some industry standards as to what certain par values are. Bond par values across the board are generally $1,000. Preferred stock par values are generally $25, although there's some exceptions, but a high percentage of preferred stocks are par value is $25. So it's important to understand this thing called par value. And 2/3 really of almost all your portfolios have a par value directly. The other 1/3 maybe doesn't have a par value for you, like the ETFs, the exchange traded funds, and the business development companies. But the fact is that the underlying investments still have a par value. And the par value has a lot to do with why your income stays the same, even though the actual portfolio itself fluctuates. So let's take a bond as an example and talk about, the fact that the income remains the same on a bond. So bonds are purchased in increments of $1,000. And when a company issues a bond for $1,000, they're going to tell you how much interest they're going to pay you every year on that bond. So they might issue a bond for $1,000 and then tell you that they're going to pay $50 a year for every bond you own, regardless of the value of the bond. So you buy a bond for $1,000, you know you're going to get $50 a year, year in and year out, right? You can count on that. Now that's 5%. But the mistake that a lot of people make is they take the 5% and they assume that if someone has $500,000 of bonds that is paying $25,000 a year, 5%, they assume that if that bond drops to $400,000, that if it drops by by 20% to $400,000, that the income is going to drop by 20% from $25,000 to $20,000. And that's the way most of you have been looking at it, unless you've understood what we've talked about before in the videos. But the fact is that $25,000 is going to remain the same. The income is going to remain the same because of the par value. Think about it this way. A lot of you have had mortgages on your homes in the past. Most of you have. And if you have a 15 or 30-year mortgage, that's a fixed rate mortgage, then your payment is the same for 15 or 30 years. That monthly payment is the same year in, year out, year in, year out, very much the same, consistent. But over a 30-year period of time, does the value of your home stay the same, or does the value of your home fluctuate? It certainly fluctuates. Does that affect your payments? It absolutely does not affect your payments. So when the mortgage company has loaned you money and they've loaned you money and you're making payments, the reality is your payments have stayed the same regardless of the value of the asset that they own. Well, it's the same thing here. When you own a preferred stock or you own a bond, they're making you dividend or interest payments, and those dividend and interest payments are going to remain the same regardless of the value of the asset that you own. So I think it's important to understand that. Now, there's another component to par value. Okay? This component has to do with the fact that with preferred stocks and bonds that have a par value in and of themselves, companies have the ability to call them, or they're going to mature at some point. Now, a lot of preferred stocks mature after 30 or 50 years, but when we buy a preferred stock, we might buy a preferred stock that is 25 years in existence already. So it might only have 5 more years until it matures. Same thing with the bond. We might buy a 20-year bond, but we're not buying it at year 1. We might be buying it when it only has 5 or 6 years left on the bond because we're buying it from someone else who owned the bond that needs to sell it. But so a lot of matter of fact, all preferreds and all bonds have a maturity date. So when a bond or preferred stock matures, then you're going to get par value back. And a lot of the bonds in your portfolios have come down by 20%. Some of the preferreds have come down by 20%. As a matter of fact, here, I'll give you the exact numbers because we had a call with Sound Income Strategies this morning. Really myself and a bunch of other advisors across the country with the money managers that are helping our clients manage the funds. We'll talk about them a little more. I want to get into some detail about them in this video. But the preferreds are on average down 20%. This is all as of Friday the 20th. So this is all as of yesterday. The preferreds are down about 20% on average. The bonds are down about 19% on average. And these are all year-to-date numbers, by the way. ETFs, the exchange traded funds, about 20%. And the BDCs are down wildly, anywhere between 30% and 45%. And as I promised, we're going to talk about why they are down in a minute. But the fact is that continuing along the lines with talking about the par value, that if in fact a company calls a bond or a preferred stock, they're going to call it. They have to call it at par value. So if a bond has gone from $1,000 down to $800 at this point, and they call the bond, then you're going to get your $1,000 back. That's guaranteed. If a company calls a preferred stock at $25, if it's down at $20 today and a company calls it, you're going to get $25 back because that's the par value. So par value is a big deal when it comes to income producing investments. And the companies have the ability to either call them or they have the ability to let them mature. And when they mature, then same thing, you get par value back. So some of you have asked, well, why would a company call a bond? Or why would a company call a preferred stock? Well, the reason is because of the fact that they like to refinance their debt at lower interest rates, just like you would if you're paying too much interest on your mortgage, right? If you're paying 4% interest on your mortgage and interest rates go down to 3% on your mortgage, then you're going to refinance. because you're saving 25% in interest. Well, it's no different for companies, okay? Companies can refinance their debt to pay less interest. And we know that the federal government just infused a couple of $1 trillion of cash into the system, and they've made emergency rate cuts. So what that means is interest rates are very, very low at this point for companies that want to refinance. So it wouldn't be a shock if a company calls all of its bonds at a higher rate, pays you par value, which would be great for you, and then refinances at a lower rate. So par value is something that's very, very important. And yet we don't spend a lot of time talking about it. We haven't spent a lot of time talking about it just because it's one of those behind the scenes things that acts in your favor that we just haven't spent a lot of time. But because it's relevant now, that's why I wanted to give you some insight. So we've talked now about why investing for income is different than investing for growth. First part of our conversation was recap. You've heard this before. I also know that people that have heard it before, find solace in the fact that they're hearing it again. When you watch a movie a second or third or fourth time, some of you a fifth and sixth and seventh time, you seem to get more out of it every time. It's just phrasing things a little bit differently. So thank you for bearing with me in the first part. And then par value is going to be new conversation to most of you that just takes you a little deeper into the investments that you have. So important to understand that. So, I think one more thing that I should mention is that historically speaking, investments that have a par value tend to come back quicker than everything else. So I think that's important to know too, is that, when this all settles out, your investments, the fixed income investments that you're in, are probably going to come back quicker than everything else as well too. So I think it's important to understand that as well. So let's move on. Let's talk about why have portfolios gone down as much as they have. And forgive me for glancing at my notes, but I want to make sure that I don't miss anything. We're at the point right now where the people are panicking. I was watching Squawk Box yesterday, and I happened to see something that was very interesting. And it turns out that the 4 major airlines are all down by 63% across the board. 63%, all of them. And yet, they shouldn't all be down by 63% because they're all different. They all have different routes. They all have different capacities. They all have different cash on hand. They all have different capabilities of meeting their debt and fighting the problems that we have. There is no way. It's really impossible that they should all come down at the exact same price. They shouldn't. But what's happened is because this virus in the stock market has happened so fast, has been so vicious, people haven't had time to do their research. They haven't had time to get in and find out, well, what is the difference between American Airlines and Delta, or between Delta and United? So the reality is that what people are doing is they're selling indiscriminately in a panic type of a situation. So now if it's an airline, they're going to sell it. And that's what happens. It's not that one's worse, better than the other, not that they're making rational decisions, but everyone is just selling indiscriminately because they know that all the airlines are going to get hurt. Now, I have a friend of mine that told me something very interesting yesterday. He mentioned, we were talking this morning, as a matter of fact, and he mentioned that he went to the bank with a $4,000 check and he wanted to cash it. And the bank said, well, we can give you up to 10 $100 bills. And, he said, why? And they said, well, because that's just been we're rationing $100 bills. Okay, why? Well, because some people are actually coming in and closing their bank accounts and taking all the money. So we really have to just ration the $100 bills. And the reality is that's ridiculous. Even in the financial crisis in 2008, no one ever went to an ATM machine and couldn't get money out of it. The Federal Reserve pumped billions or trillions of dollars of liquidity into the system to make sure that our system still ran properly. This is not a financial crisis. Closing a bank account doesn't help you at all. It makes no sense. But when people panic, they tend to do things that don't make sense. And that's what panicking is. And no good decision is ever made when you panic. But when people panic, they're going in and they're pulling all the cash out of their bank, or they're selling their stocks. And so people will just sell the stocks indiscriminately. Oh my gosh, it's a stock, I'm selling it. They're not doing any research or just selling it. And then the stocks went down so fast that now all of a sudden it was like, okay, I can't sell anymore. It just doesn't make sense. I can't sell. I got to hang on to this. So what else can I look at? Well, bonds. Okay, well, the bonds have done okay. So I'll start selling my bonds. And then they kind of come down in value. And then they're a little low. And then what else? Well, the preferred stocks and then the BDC. So the bottom line is that it's this is all panic sales. The fact that people are pulling their cash out of the bank, the fact that the airlines are all down the same thing, it's just really representative of just panic selling. And when people get into a panicky situation, they will sell just about everything. I mean, it's almost like if you're underwater, right? If you're underwater and you think you're going to drown and that lifeguard's there, you're going to grab the lifeguard. Even if you pull him down and drown him, you don't care. And that's what's happening. So it makes no sense that the bonds are down 20%. It makes no sense that preferred stocks are down 20%. This doesn't make any sense at all, but people are panicking. And that's why everything has really come down as much as it has. And we have to remember that when income producing investments drop in value, it's just a paper loss. The reality is that I hear stockbrokers all the time use the term paper loss in a manner that's just not right. It's not truly a paper loss. If your stock goes down in value, there's no guarantee you're ever going to get it back. If your income investments go down in value, you're guaranteed to get it back at some point, whenever it matures, right? Or whenever they call it. But that's not the case with the stock. So it's really not a paper loss. It really could be a permanent loss. But with income producing investments, it really, really is a paper loss. And interestingly enough, people are scattering to sell their stocks, not realizing or that they're panicking, and they're doing the same thing with the income producing investments when in fact they shouldn't be. Matter of fact, BDCs are a good example. Business development companies are the asset class that in our clients' portfolios are down the most. Anywhere between 30 and I think maybe 50%, somewhere in that range. I think on average about 45%. But the reality is that businesses or business development companies, BDCs, what they do is they loan money to other businesses. So the underlying loans have maturity dates. They've loaned out money, and just like when you borrow money from a bank or credit card, there's terms there. So you have to pay it back at some point. And the same thing with the BDCs when they loan out money to other companies. But BDCs are retail products. They're not really invested in by institutional investors. They're retail products. And because it's the retail sector, it's the private individuals that are panicking, not the big banks, not the institutions, not the mutual fund companies, not the insurance companies, but because it's the retail investor that's panicking, and because BDCs are a retail product sold to investors, well, it makes sense that they're down more than anything else because they're driven strictly by sentiment of the public that is just trying to sell everything they can, hoard whatever they can, and make sure that they get whatever cash they can, even if it means closing their bank account when there's no reason at all to do that. Bonds. There's a way to divide bonds into two classes. Classes that are held by institutional investors and classes that are held by retail investors, okay, non-institutional investors. And when you look at these two classes, the retail class has dropped in value a lot more than the institutional class. So it's all because of panic. It's because of overdone fear, overdone panic. That's the only reason why the income producing investments have come down a lot more than they should have. Think about it. A business development company, a BDC, as I mentioned, loans money to other businesses. And BDCs are often known to be a little more intimate with their businesses than banks. I often refer to them as a bank to businesses. There's a lot of reasons that big companies and small or medium-sized companies would need to use a BDC, but BDCs tend to be more involved with the businesses that they work work with. So they tend to know the businesses better. The loans are larger with these businesses. And yet the BDCs have still come down 50% in value. So what that means is that if they've come down, 50% in value, then that means that the market is expecting that half of the loans in there are going to go bankrupt. Half of these multi-million dollar, even tens of millions of dollars of loans are going to go bankrupt. Folks, that's not going to happen. If half of these small businesses and medium-sized businesses go bankrupt across the country, we're going to be looking at a serious depression. We could be looking at a Dow 1000. It's just not going to happen. It's a ridiculous concept for the BDCs to be coming down at this price. As a matter of fact, a smart thing to be doing at this point would be to be buying BDCs. So because we know that eventually they're going to come back. And even if 20% of the businesses went bankrupt in there, it's certainly going to be a major hurt. So it's irrational. It's an irrational selling, panic-based selling of the investments that are inside the income-producing portfolios. And that is what's driven them down more than anything else, not the fundamentals of the company. Strict panic. When the tide sinks, everything sinks with it. And when it all levels off and everyone gets their senses and all the big investors out there, the guys that aren't panicking, the guys with the money aren't panicking. When that happens, if you panic and you sell your BDCs, they're going to be very glad to take them. They'll be very glad to buy them. And because everything has come down in value, whether it's the bonds or the preferreds or the ETFs or the BDCs, when everything calms down a little bit, then the tides start to raise. Well, income producing investments historically have tended to come back a lot quicker than stocks, okay? A lot quicker than stocks. So I think that's something that we can look at. And part of that is because of everything we've talked about, including the fact that they have a par value. So I think it's important to understand that as well too. So let me take a look and see if there's anything else. Yeah, there is. A couple other big things, as a matter of fact. Sound income strategies. I want to take a few minutes and I want to talk about them. Now, most of you are familiar with who Sound Income Strategies is. That's the management team that we use behind the scenes that, every day while I'm meeting with people, they are doing research on the different investments that we are recommending, the different income producing investments. And there's about 100 different investments, maybe a little north of 100 different investments that essentially they're using on a regular basis. So they really know these investments inside and out. And their typical protocols that every 2 days, they're going to, let me back that up. Every day, they're going to review very thoroughly 2 investments. That just means doing all the research, looking behind the scenes, making sure everything's okay. So that means that once a quarter, they can get through and look through all the investments. And this is just what they do. They keep recycling. And if they find an investment that's starting to slip a little bit, then they can replace it with another investment that they're starting to realize is doing well. And so it's just constant management, constant watching over the different investments. And normally once a quarter is acceptable because quarterly results come out and nothing really changes until you get the quarterly result anyway. So it's a great time for them to do it. So this is what's been their normal practice behind the scenes. But the reality is that in the last week, they have looked at these 100 investments multiple times. They've been working very late hours. They've been working weekends, and they're looking at the investments over and over, even to a point to where they've said that they'll look at an investment today, and 2 days later, their research is all out the window because things have happened so fast. But that's what they're doing. But what they wanted to know is they wanted to know a couple of things. And one thing that they really wanted to know is they wanted to know worst case scenario. Worst case scenario, if the companies who have issued these investments, whether it's the bonds or preferred stock or anything else, the BDCs, they wanted to know that if the companies that have issued these investments, if their revenue stopped completely, how long could they go without cash? How long could they go without revenue, I should say, and how long could they survive? And they kind of broke it down into a couple different categories. Could they survive 6 months? As one category. And then could they survive to the end of the year? That was kind of the secondary category. So they looked at all their investments with these questions. And there's more to it. I'm giving you the simple version. The reality is that with these investments, that it's not just about the cash they have on hand. A lot of the companies might have real estate on hand, but it's very hard to liquidate real estate. But those companies might have huge lines of credit that will get them through. So they had to look at the lines of credit. They had to look at the debt. There's a debt service ratio, meaning how much revenue has to come in to pay the interest on their bonds, their debt. And then of course, if no revenue came in, but they still had their full payroll to meet, they still had all of their operational expenses to meet, how long could they last? And that's worst case scenario, because no company out there, the revenue stops 100%. I mean, even the airlines, people are still flying, so it's not 100% loss in revenue. And that's true for most of the companies. Is there's still some revenue, although it's going to get cut. There's still some, but they want to know, what if there was no revenue? Well, the good news is that out of 100 plus companies or investments that they have, there really were only 3 that had less than 6 months of cash. They could survive for less than 6 months. Okay, so there were only 3 investments that could survive for less than 6 months. There were another 6 or 7 that are kind of on their watch list. Okay, kind of that they're not terribly happy about, but no reason to panic. But the rest of them are in good shape. The rest of them are in great shape. So the portfolio overall is in good shape. And when they did this research, it should give you some solace to know that the companies behind the scenes are really doing as good as they could be, and really have the cash to go, most of them, at least a year. And some of them can go well beyond a year as far as that's concerned. Now, we don't expect this to last till the end of the year. The governor, or the news report that I read earlier, was talking about, I think it was April 10th, but somewhere in the second week of April is when they're saying everyone will be able to go back and businesses will be able to open up. So we're only talking about 30 days, and none of the companies that are in your portfolios have any problem within 30 days. But what Sound Income Strategies is going to do is they're going to be proactive. And if they think that there's going to be some problems down the road, they may very well decide to trade out some of these companies. And your portfolios are diversified. There's really not more, other than maybe a few exceptions, there's not more than 2 or 3% in any one particular position. So even if, in fact, they had to take a 50% loss on a BDC that they decide is time to get out of, well, if that BDC represents 4% of your portfolio, let's say on the high side, and they take a 50% loss, and that just means you essentially lost 2% of your portfolio. That's like 4 months of interest. So it's not a big deal in the end. It's certainly not as big a deal as a 25 or 30% that some of your portfolios have fluctuated down at this point. So you really have to hang in there. You got to hang in. You're going to keep getting your income along the way. You've got to let Sound Income Strategies do their job. That, believe me, they got guys that are brilliant behind the scenes that are just doing the research to try to figure out the best way to go, and trust them. That's why you've hired us. That's why we've hired them. Another thing that I want to mention is that they have also made a decision just in the last couple of days to sell the money market mutual fund that they had put most of you in for short-term cash, and put all that money back to a traditional money market. So let me explain this for a second. You've got a money market, and then you've got a money market mutual fund. The money market itself is just a cash account. It's an FDIC insured, like a bank account, that's going to pay you like a bank, like 0.1% or something like that. And then you've got money market mutual funds, which is really a mutual fund that has a lot of money market instruments in it, a lot of short-term debt, banknotes and stuff in it. And whether you have a money market mutual fund or whether you have a money market account, both of those are priced at $1. Okay, $1. So money markets by themselves are priced at $1, and the money market mutual fund is priced at $1 because everything in it is priced at $1. But the money market mutual fund's not insured. And the reason that Sound Income Strategies in the past 6 months or a year transferred a lot of your money from the money market account to the money market mutual fund, because the money market mutual fund, because of things that they can do that you couldn't do in an individual money market, will actually pay more interest. And it's typically been paying you between 1.5% or 2%. So it's not a long-term strategy. They haven't put it there with the idea of keeping it there forever, but they want to have some cash in a portfolio for a situation like this. So they've had a little more cash on hand than normal. And if they're going to do that, why leave it in something that's paying 0.1% when they could be getting 1 or 1.5%? So bottom line is they decided to to within the last year put everything over here, so at least you're getting 1.5-2% a year. But now, since interest rates came down, money markets as a whole have come down, and so the money market mutual fund has come down and now is only paying like 1%. And there's very little risk in a money market mutual fund than there is in a money market fund. Very, very little difference in risk. But the money market account is insured. The money market mutual fund is not. And in 2008, when we had the financial crisis, there were some money markets that what they say broke the buck, meaning that they're all valued at $1, and if they break $1, then that's not good. And in 2008, they broke the buck. That's what that means. So there's really maybe a 5% chance that happens again with where we are now. But just because the yield is only 1% in the money market mutual fund, they've made a decision to liquidate the money market mutual fund and make the money just a tad safer by putting it into the money market account. Just the only difference in safety is that this one is insured. This one is insured. So that's the difference. So you're going to see that your money went from the money market mutual fund over to the money market account. So I think that's just important. Some of you have already seen that. We've already had some questions about that. So I figured I would address it in this video. So the last thing that I want to cover is the fact that history tells us that this is probably going to get a lot worse before it gets better. It's definitely leading us into a recession. I don't think there's any doubt about that from really any opinion that you asked from people that are in the know. It's definitely going to lead us into a recession. Now, how big of a recession or how deep of a recession, we don't know. Is it going to be mild or severe? I mean, that we don't know. I tend to think that it's going to be more moderate. And the reason is because we had such a strong economy going into this that I think that's going to help. That's going to help. And most companies out there are positioned with enough cash to be able to ride it out for, a few months or 6 months like we talked about. So, and then they're losing revenue. GDP is absolutely going to go down. Unemployment's absolutely going to go up. But in the end, I don't think it's going to be a severe recession. We have a light at the end of the tunnel, and this virus is not going to go on forever. At some point, businesses and counties and then countries will ultimately open up for business again, and we'll be back at usual. And I would expect that the stocks will jump at that point. Maybe up 30%, maybe back to where they are now. But between now and then, if we have another 30 days of no revenue for a lot of these businesses, and maybe a couple of these things do go bankrupt, whether they're in your portfolio or whether they're not, it's certainly not going to be good. And very rarely, matter of fact, I think only one time in history, I think the only time that the market ever recovered after something this substantial was in the 87 crash, where the market recovered right away. But all of the other crashes that have ever happened, what's happened is the market will come down 20 or 30%, and then it kind of mellows out. And it's almost like everyone feels good about things again, and we're waiting for it to go back up. And that could last for months, and then it takes another leg down. We've seen that happen over and over again. So I really hope that we're at that mellowing level. I mean, last Friday, the 20th of March, the market went down 900 points only. When you say only 900 points, it's been bad, right? We had 3,000 point down day once on the Dow. So it only went down 900. The day before, if I remember correctly, was up day or flat day, but I think it was slightly up. So maybe we're mellowing out a little bit. But I don't want you to think that just because we mellow out here that the ride is over. It's almost like if you're going down the rapids, right? And you get in the rapids and you get out of one rapids. Well, that the river goes downstream and there's more rapids coming, and that's just the way that it is. Now, a lot of you have contacted my office and told me that the video that I did last week have really helped. Just reminded you of why we're invested for income. Reminded you of using the rental analogy that your portfolio is going to fluctuate. So a lot of you have called us and just thanked us for reminding you of how things work. But there's a number of you out there that are still panicking, that are still worried, and maybe even having a hard time sleeping at night. I mean, the whole country, the whole world's kind of jittery at this point, and and some of you are jittery with regards to your life savings, and that's, I understand that. I mean, it's it's a situation where it's your money. It's tough. This is what you've worked hard for. You don't want to see it disappear. I mean, the Dow Jones in 30 days has gone down 30%, 32%. So it's just, we've just never seen this before. So if you're in a situation where you're panicking, and you decide that you may want to make a change, then call me, let me know, and we can certainly talk about that. When we met, and we took you on as a client, we went through the process, whether it was with me personally or one of our advisors. We went through the process that we refer to as our Conservative Money 101 tutorial. And in that process, we talk about all the conservative insured investments. And then we talk about all the moderate non-insured investments, the uninsured investments. And we made some decisions based on conversations. We decided that, we might put some in the conservative and some in the the uninsured. So some in the insured, some in the uninsured. And, every one of you is a little bit different. Some of you might have put 60% into the uninsured and 40% into the insured items, or vice versa. And you might be thinking now that if you had to do it again, you would do it differently. You might be thinking now that if you had to do it again, you would have put more in the insured category. And the reason that I'm saying this is because it may not be too late. Again, that it depends on you. The reality is that we could have another leg down. I think it's likely that we have another leg down. Keep in mind, 2008 was a 63% drop, and so far we're only 32%. So we could mirror another 2008-like scenario. And some of you might be saying, look, you know what, I can't stomach it anymore. I still have enough to live the rest of my retirement very comfortably. I don't need to take this risk anymore. And it may be costing you some sleep. And I think that's a minority of you. But if that's the case, call my office. We can talk about, does it make sense to make a shift from some of the non-insured investments to the insured items as well too, now that we're going through this. So call me and let me know. Now on the flip side, there's a lot of you that wanted to take advantage of the conservative investments, knowing that a time like this was going to come. So a lot of you have overweight, in conservative investments. Maybe you've got 60 or even 70% in conservative investments, and because you have that money there and you haven't lost a dime in the conservative investments, then you might, a lot of you that have called me, this is the most common call we get, by the way, is people wanting to be opportunistic, and because the market is down, wanting to buy back in. I had an email, matter of fact, I've had a couple of emails of people that said, hey, you got my money, put it all in the market at this point because we're already at 32% discount. So if you're on the other end of the spectrum and you've had conservative investments and your money is safe and insured and you haven't lost a dime and you want to buy into the stock market because now's a better time, let me know. Call my office and let me know. And I would certainly love to help you do that. Well, the purpose of this video for me was really just to help you feel better. You'll be getting this video Saturday evening sometime, March 21st. And I want you to have an enjoyable Sunday. And I really want you to have an enjoyable even rest of the week. We can't take the nervousness away. Everyone's a little nervous. Everyone's a little jittery. But the reality is that, we've survived a lot of things in the past. We as a country, we've survived the flu of 1918. We survived World War I and the Great Depression. We survived World War II. We survived hyperinflation in the 70s with all the gas lines. A lot of us remember. We survived the tech bubble and WorldCom and Enron. Prior to that, we survived the crash of 87. And recently, we've survived the financial crisis. And we're going to survive this too. And I wish I could answer the one question that everybody has, every single one of you, and that is, when is this going to end? I can't answer that. But if you think that you want it to end now, that's okay. It's your money. Let's have a conversation about that. But the rest of you who aren't panicking, then just hang in there. And again, I said earlier, I'm proud of you guys because most of you know the game. Most of you know that there's no reason to panic because you continue getting your income. So I really appreciate that. But my phone is open, email is open. Any questions you have, please don't hesitate to call my office. We're here for you, even just to have a discussion if that's what you want. But I hope this video has helped. If so, great. If not, please call me. You guys have a great rest of the weekend. Enjoy. God bless.